Hello and welcome, dear investors or dear speculators or whatever it takes. It's about Cyberpunkt 2077 or the company which published it. It's about CD Projekt. We analyze the stock. It's a Polish stock. It's a stock, they already paid dividends, but it's not a typical dividend stock. But it's an interesting stock anyway because the capital gains were really crazy over the last decade or even decades, though they outclassed the performance of Amazon, for example, and they are releasing the most awaited, most acclaimed video game this year. They are going to release it in the next 2 weeks, within the next 2 weeks, 10th of December. And this stock is newly covered on dividend stocks cash. Normally we cover more solid stocks, more predictable stocks, very often stocks paying dividends, but this time really something else. It's a different animal, but really interesting anyway, and I think you will learn something if you watch this video. Okay, let's go. They are going to release this game, Cyberpunkt 2077. They already released The Witcher 3. If you play video games on PC or any console, then I'm sure you know these games or you even own one of these. This one probably not. You might have pre-ordered this, but this maybe. Okay, when I was first adding CD Projekt to the screen on dividend stocks cash, I was unsure if we have a data flaw here, because look at that, they have Polish zloty in Poland. Just if you're an American or so, you might not know that they have not the euro, for example, they have Polish zloty, and the earnings per share was less or is less than 3 Polish zloty within the last 12 months, and they should boost to more than 20 Polish zloty within a very short period of time, still for the current business year. And the same with the revenues, from 670 million Polish zloty to close to 3 billion Polish zloty, about close to 5 times more within just some months. So normally this isn't supposed to happen, and this can't happen for regular companies, but for companies selling digital goods, that's really possible, especially if it's a game like this, which is the game most people in the world are waiting for in this year. So if it will be released, as it's probable, or if management wants, on 10th of December, they still have 3 weeks to boost their sales. 3 times we already had a delay. The stock got a bump and then a recovery. Stock price went down, recovery. Okay, now stock price went down. There was the last delay and then a slight recovery. And you see that the stock is really volatile, but you can also see just in a moment that the capital gains of this stock in the long run were really, or are really crazy. And but first, let's have a look at the evolution or at the strategy of the management, how they make this company grow. We see here kind of waves, a wave formation, and the waves are getting higher and higher, both in revenues and earnings. And in 2015 was the release of The Witcher 3, this game here. And before the release in 2014, they had revenues of about 100 million Polish zloty, and after the release of the game, 8 times more, about 800 million Polish zloty. And the same should happen once again, from about 700 billion, as I already said, to close to 3 billion. And with revenue, the same as for revenues is also true for the earnings, from 7 Polish zloty cent, if that's the right name, to 361 Polish zloty. So really magnitude larger, and the same should happen once again from to 70 Polish zloty to, yes, more than 20 Polish zloty. Okay, so they are a one-trick pony, this company. They release one big game, and this game must be a hit. If it's a hit, it will make revenues grow and earnings grow, and then they will have to, then they will release additional software based on the very first games, or they release downloadable packages, multiplayer, whatever. But anyway, the revenues and earnings will go down, but they are still higher than they were before the release, before the major release of the game. And the company is still profitable and needs to be still profitable to develop the next big game. And this takes some time, about 5 years, I'd say. What is very important to see is that while the revenues and the earnings go down, the cash flows are still very positive, and you see that the company CD Projekt has no debt problem in any ways. They can cover all their debts or pay back all their debts using the cash flow of a single business year. So their balance sheet is really, really strong. You don't need to worry for bankruptcy. Now, after we understood the management strategy, how they make the company grow, and understood that there is no problem of liquidity, let's have a look at the risk-reward profile for you as an investor. And we go into the valuation tab right here. Normally, we use the dynamic growth calculation or dynamic fair value calculation to calculate fair values of much more predictable companies. In this case, we have a very unpredictable company with these earning and cash flow formation or waves, and we can't just apply fair value calculation out of the box. That's completely not suitable, but we can still use the matrix we have here. I enlarge it a little bit for you to make it more clear to see. We can still use these multiples, and we can look at the very first success wave of this company and then conclude what to expect from the second one. So let's zoom in and let's see what happened during the release of The Witcher 3. So the company was valued with multiples of about 6. That's the price earnings, price to cash flow of round about 6. And this was the big success story I already explained, or I already showed you. And this was when the game was released, by the way, somewhere in April or in May, somewhere here in spring. And then we had multiples of about 6, although the release was very successful. So it was most probably a stock not fully completely understood or not fully completely covered, with not so much interest. And then the interest began to awake, and then we had here nice capital gains, 130% over one year here, and then over 2 years 110% each year, in total 340%, and even the very next year, within the last 3 years, come on, here it is, and then here 560% capital gains each year, 90% capital gains. And this is really, really tasty for each of us investors. And now people ask themselves if they see the next wave coming, if they can expect the very same. And I think it's important to understand that the multiples here were really low, with multiples around 6. Then the multiples doubled from 6 to about 12, and then they even tripled from 12 to about 42. They even more than tripled. So the stock became more and more expensive because it was very, very inexpensive in the year 2015 after the release of The Witcher 3. Now zoom in into the present, and near future. And here we have multiples of 18. So the valuation of the stock is 3 times as high as it was during the release of The Witcher 3. And this already takes into account that the analyst dreams come true, so that the Cyberpunk 2077 will be a success story, so that all this here becomes true. And then we have multiples for the year 2020 3 times higher as they were in 2015, back in 2015. And you see already that the expectations of the market are much higher than they were 5 years ago. Here we are right now, and that's the problem with the stock. I might say that I don't think that we will see a repetition of these high capital gains as we have seen, because the stock is already much higher priced, and that's the point I want to show you. So yes, I think not so much upside potential, and we are not going to see a repetition of what we have seen here. In contrast, I might think that the expectations are really rather high, and even if the analyst estimates come true and the earnings will go up as we see here, then the stock price might still go down because the market expects a little bit even more than the analysts expected. So there's really a risk involved in the stock, and for me the company is good, its products are probably very good and nice games, but the stock's risk reward profile to me is not really attractive, and I'd rather stay away from this company. That's just my point. I'd like to get a comment or read some comments how you feel about the stock, but I just wanted to show you how I approach a stock like this. You can't approach with the regular approach for which accounts or which is valid for more predictable stocks. Okay, I hope you'll like this video. That was something else, and see you next time. Bye bye.